Coming up in this episode, it's been a wild week. Nvidia is caught up between China and tariffs. Powell's stagflation talk rattles Wall Street, and now President Trump wants him gone. Consumer credit falls, stock splits confuse new investors, and once again, DKI has opinions, strong ones even. This week, we're calling out flawed narratives, breaking down the data, and showing you what really matters. Stick around because at the end, we'll tell you what the market noise is missing and how to see through it like a pro. Hi, everybody. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. He also has some big news this week. Rob, what is going on in your world?
Yeah, some big news. Obviously, had a great Easter weekend. That was awesome. Celebrated with family. But my mom turned 60 years old. So it's actually today. Her
Amazing.
birthday, 60th birthday. And then my dad's birthday is tomorrow, but not as big of a milestone. So this is definitely Mom's Day. I had to do a big shout out on the DKI 5 things. Let her know, Mom, happy birthday. I love you. Hope you're watching. Yeah, happy birthday.
Well, happy birthday to the entire Farian family.
Yeah, mine's next Tuesday.
All right.
Yes. So a wild week in April for us, for sure.
We'll have to get special hats for next week's show.
I think that sounds good. That definitely sounds like a plan of attack for sure. But Gary, we got a great issue of the 5 things, the double Nvidia issue today. We're talking a lot of different angles. Obviously, Nvidia makes an appearance. We're talking about Powell and President Trump, stock splits. We had some fun with the intros on the way some of that stuff was phrased in the written version of the 5 things. We found a tongue twister. We're talking consumer credit, all sorts of different stuff on this week's version of the 5 things. Gary, we'll jump right into it. Thing number one, we're talking Nvidia. They took a $5.5 billion charge due to new limitations on exporting to China. We're asking, okay, what does that mean for the options that China has now? Gary, thing number one, Nvidia's curbed exports to China. Tell us more.
So, Rob, this to me is a fascinating cat and mouse story. And you're right, Nvidia did just take a $5.5 billion charge related to a new export ban on their H20 chips. And so the ban is simply they can't send them to China. So here's the story on this. What happened was the prior administration, the Biden administration, reasonably said, hey, Nvidia, you cannot send your best chips to China. And Nvidia said, okay, well, what do we do? What can we send them? And so the Biden administration, they went to their tech experts and they said, well, what makes Nvidia's best chips so good? And somebody said, well, it's the bandwidth, how fast the data moves through memory. And so, the Biden administration said to Nvidia, well, you can send them chips, but, you have to restrict this one thing. And they understandably thought that they were restricting the performance of the chips. And, that should have been the end of it, except, Nvidia, being really good chip designers, found a way to take this H20 chip and make it almost as good as their very best chips. And so they were supposed to be sending these degraded chips to China. Instead, what they were sending them was something that was just almost as good as their very best chips. And if you put a bunch of them together in a server, you had something that was pretty close to what the US AI accelerators were using. And, the models that they use to train the large language models. And so, China said, okay, wow, this is great. And, on a prior version of the 5 things, we said, okay, look, Nvidia is complying with the law technically, but they're, kind of getting cute and skirting it. And, I understand how the Biden administration made that error. Had you and I been in the room and heard this is the thing that makes, the best chip special, we might have come up with the same solution. It's really hard to blame the Biden administration for getting that one wrong. I don't think it's their fault. And it's hard to blame Nvidia for saying, okay, we will technically obey the restrictions, but send China the best thing that we possibly can. The Trump administration has decided they'd had enough of that cat and mouse game and said, yeah, stop sending the H20 chips to China, which also was the right move. So, it's a situation where I understand the error the Biden administration made. I don't think it was their fault. They got it wrong, but under the circumstances, we would have made the same mistake. It's hard to blame Nvidia for doing the best they could for China, their customer, under the circumstances. They got a little too cute with it. And, I think the Trump administration just made the right call by saying, yeah, enough of this nonsense. Stop sending the H20 over there. And so that's where they are. China and Hong Kong right now make up about 13% of Nvidia's revenue. So, this is an issue. And one of the things to remember is that one of the reasons Nvidia has such a high valuation is because the company grows really quickly. Well, 13% of their business is now, facing headwinds, and any cut in those ultra high growth rates are going to affect the valuation. And that's something that we've seen over the last, few days to week.
Gary, with all this shaken out, I mean, what options do you think that China even has to deal with this? I mean, what do you expect their next moves to be based on this information?
So, again, I guess the theme of this particular one is everybody's doing the wrong thing, but nobody's crazy. China's doing what you and I would do in that situation, which is they are working on developing their own. As of now, China does not have anybody producing chips that are in NVIDIA's league. And in fairness, that's not a shot at China. No one in the world has that capacity. NVIDIA for years has been making the best AI accelerator chips. And, they're very difficult to compete with. But China now has to start developing their own. And I think we can expect to see over the next few years a large increase in China's at-home capacity. And I think that's the thing that we're going to see. The one other thing that I would add to this is we've seen some really interesting reports that some Asian countries are buying more NVIDIA GPUs than they have power capacity. So think that through for a minute. If you need a certain amount of power to run those chips and you have more chips than you have power to run them on, what are they doing? And I think the implication here is that shell or proxy companies in other countries are sourcing NVIDIA product and then shipping it back to China. So, one of the things that we've said ever since, the DeepSeek news came out, and I think it was late January, I think it was late January. One of the things we said is it is very difficult to maintain a ban on small, untraceable, high dollar price chips. You put them on a plane, it just doesn't cost that much, where these chips cost tens of thousands of dollars a piece and they want to buy hundreds of thousands of them. There are literally billions of dollars at stake here, and it's just not that hard to buy these chips in another country and ship them over. So we've suspected that was going on all along, but I think seeing some Asian countries buying more chips than they can possibly power is a pretty good indication that we were right back in January on that.
Yeah, very, very interesting and fun to think about them actually doing that, moving that back and forth. Gary, so again, we're talking the double NVIDIA issues. So we're going back to back, diving into NVIDIA. This second piece, we're talking about their production of the best chips that they have in the United States. We're going to talk about what that does for our view on tariffs, something we'll cover as well for them. Gary, thing number two, again, the double NVIDIA issue. Thing number two, NVIDIA brings chip making home to America.
So, Rob, this one has me excited. I know we generally try to be neutral arbiters. We try to be kind of like an umpire and call it like we see it, but I'm actually excited by this news. One of the justifiable, reasonable complaints that people have had about President Trump's tariffs is they've said, if you raise tariffs now, it's going to hurt us now, and it will take years to start to build and develop onshore manufacturing. And I think that's a reasonable complaint. You can't just build a factory in a week, right? I mean, just to get the organization and financing and design and permitting could take you years. And so, what people were saying is we're going to take the pain now and we're not going to see the benefits of it, of the increased domestic manufacturing for a number of years. And I think it may be worthwhile to take that hit and to pay that price, but I think it's valid criticism that people have had over President Trump's plans. Well, guess what? Nvidia last week disclosed that they have already started producing their very best next generation Blackwell AI chips in Arizona. They are partnering with TSMC, that's Taiwan Semiconductor, and they have over 1 million square feet of manufacturing space that they're putting together also in Arizona and Texas that will allow them to produce their best AI chips and supercomputers in the US. Some of that's related to tariff related motivation, and other companies may follow as well and start producing here. But we're excited to see it. Nvidia is talking about $500 billion of product over the next 4 years. That's a really big number. Thrilled to see it. And other companies that Nvidia is partnering with on this is Taiwan Semiconductor, Foxconn, Wistron, Amkor, and SPIL. And so, we're going to see more high-end U.S. production. And I think that's something we need to do. Not being able to produce our own chips is a national security issue. It leaves all of our industries and our best industries and our weapons manufacturers, and just so much of US security is related to chips, and it leaves them all vulnerable to future geopolitical disruptions. I'm thrilled to see that the world's best chip maker is now producing here in the US. And that is not, well, we'll do it down the road. And people have talked about that a lot. No, they are already producing.
Gary, I can tell with your excitement. I think I know the answer to my follow-up question. Is this a win for the Trump administration? Assuming yes, it is. I mean, how big of a win is this for him early on in his presidency?
I think it's huge. I mean, the fact is, not just this administration, anybody, with a brain would have identified our two biggest vulnerabilities in our geopolitical supply lines or international supply lines as semiconductors and pharmaceuticals. Getting the best chips made here in the US and in conjunction with Taiwan Semiconductor, the best chip maker in the world, I think is huge. And that, a lot of people have complained about President Trump's tariffs, but let's celebrate the wins. This is a huge win. Also, for the Democrats in the audience, standing ovation here for the Biden administration's CHIPS Act. That certainly helped bring more production home. So, when you're saying, is this a huge win for the Trump administration? Yeah, but I also think it's a win for the prior administration as well. This is a bipartisan win. There were Democrats who supported funding for this kind of thing, and they deserve a round of applause on this one. Right along with the Trump administration.
Yeah, that's great. And I think that's what we should really be talking about. Is it's a big win for America, a good thing for chip production, national security, jobs, the whole 9 yards. And I don't think there's any way you can argue that.
Yeah, Gary, absolutely, Robin. And we should be celebrating people on both sides of the aisle who made this happen. This is also a win for Democrats, and like you pointed out, what we want is a win for America, and that's what we got here. So great job to everyone involved.
You're watching the double Nvidia issue of Deep Knowledge Investing's 5 Things to Know for this week. Please check out our website, deepknowledgeinvesting.com, where you can go sign up for a free subscription. You'll be notified via email when we release each week's version of the 5 things. We'd also love if you consider signing up for a premium subscription. That'll get you access to all gated content, as well as current recommendations and buy and sell signals coming from Gary. Gary, moving to thing number 3, we're talking stagflation. Jerome Powell, our friend, markets all over the place. You're asking, what should we know? Why don't we care about the Fed? I think I know where this one's going.
We've covered it before.
Gary, thing number 3, the Fed is trapped and irrelevant. Maybe we could get a hashtag and the Fed in there somewhere.
Yeah, there you go. It's my favorite hashtag, by the way. By the way, that hashtag and the Fed auto completes on every one of my devices. If I hit hashtag and the Fed, immediately comes up. So that's my auto complete choice. My phone knows where I'm going with that. Anyway, Rob, last Wednesday, Jerome Powell, who's the chairman of the Federal Reserve, addressed the Economic Club of Chicago. I know you guys are thrilled to hear this exciting news. And he promptly crashed the markets. So Powell talked about new tariffs, reducing economic growth, increasing inflation, and that's the recipe for stagflation. and it would put the Fed in a bind. So typically, the Federal Reserve responds to higher inflation by raising the Fed funds rate. And what that does is that pulls money out of the economy. It makes the cost of borrowing more expensive. And so fewer new projects get started. It slows the economy, and you end up with lower inflation typically. Now, their response to low economic growth is the opposite. It's the stimulus of lower rates. So if you have low economic growth, you lower rates, and all of a sudden it's cheaper to finance new projects and more gets done. And you can have more allocation to building or misallocation to building, as we've seen all over the world. But the problem with stagflation is it means that no matter what the Federal Reserve does, they're going to make one problem worse, right? If you raise rates, you're going to kill growth. If you lower rates, you're going to increase inflation. So it leaves them stuck. In addition to that, Powell also crushed hopes for a Powell put. Don't worry, I'll explain what that means. By indicating he was not going to bail out a falling stock market with a hope for rate cut. So this is a reference to the Greenspan put. If we go back a couple of Federal Reserve chairmen, when Alan Greenspan was the chairman of the Federal Reserve, if the markets went down, he would have a tendency to lower the Fed funds rate. And what that would do is the stock market would price in more growth and would immediately come back up. And so people were more comfortable being long stocks at that time because they felt like the chairman of the Federal Reserve was going to bail them out on any losses. It was called the Greenspan put. It was like you had a put option where if the stock prices dropped below a certain level, you were going to get support. And that's what you have if you own a put option. Well, Powell made it crystal clear there's no Powell put, and he was going to let markets go down. The markets didn't like that. And, we've seen what's happened over the last few days. Now, even though Powell, was very negative on President Trump's policies and on the economy, President Trump, of course, took it in stride. And, oh, wait, he had a lot to say. We'll get to that later in this episode.
All right, Gary. So obviously with the market reacting, a lot of the market took Powell's comments negatively. How concerned are you by what Powell had to say?
No big deal. So the markets got upset. I'm completely unconcerned for three reasons. First, the DKI portfolio is heavily hedged. We do not need a rising stock market to make money. I'm not a fan of people who, their investment plan is fingers crossed the market rises, or the asset allocators, or, closet indexers who need the Fed to bail them out and get a rising market to make money. There's no skill to that. You're just begging for asset bubbles and for the Federal Reserve to make your case for you. I would rather do it on stock picking. And that's why we've hedged out our portfolio. Our hedges have made us a ton of money over the past month. Second, I'm not actually convinced tariffs are going to lead to long-term inflation. I understand the logic for why people think it will happen, but it's not clear. And if you remember, during President Trump's first term, he increased tariffs. We did not have an inflation problem. Over the weekend, I read a great, lengthy, well-researched article by Anthony Pompliano. And, he went back through the history here. And I think the thing that people forget, everybody gets stuck with static analysis, but the world is dynamic, right? And what that means is people assume X happens, therefore there's an impact on Y. Well, yeah, but when X happens, the people handling Y will move. The market, the world adapts to the new circumstances. And so, yeah, there's no question that tariffs can increase prices on overseas goods, but it also encourages more domestic supply. And that's one of the reasons why tariffs don't always lead to long-term inflation. So I'm not in the doom and gloom camp on that. And we really do need to restart domestic manufacturing. Just too much of the country is out of work and, suffering from depression and drug use. And we just need to do something. And I think this is a way to do it. The third reason I'm not so concerned about this is because congressional overspending has led to fiscal dominance. And that's just a fancy way of saying congressional overspending and debt has gotten to the point where the Federal Reserve really doesn't have any ammunition anymore. If the Federal Reserve cuts, the bond market's going to price in higher future inflation and rates on longer term treasuries will rise. That's what happened last September. And when that happens, what do you end up with? You end up with the government having to print more money to pay interest expense. That leads to more inflation. In other words, no matter what the Fed does, it doesn't matter. The expression from a couple of decades ago is pushing on a string. So imagine there's a string between the two of us. I'm the Federal Reserve and I want to affect, how things happen for you. And so I push on the string. Well, what happens? Your end of the string doesn't move, right? My end moves, but there's no impact from it. And I think that's where the Fed is right now. There's not much the Fed can do at this point to get control of the situation. So, the question is, what do you do, right? Because the Fed's saying we've got a disaster coming. And I'm saying there's nothing the Fed can do to fix it. The Fed is telling you there's nothing we will do to fix it. So what do? The answer is to hedge for, a popping of the bubble and to prepare your portfolio for more inflation. That's what I do all day, every day, right? We are focused, I think, in the right place on this one.
Yeah, and I think that's a great point, Gary, just in terms of the value of deep knowledge investing. And what you do is, regardless of the market, good, bad, what decision gets made, what happens over the course of a period of time, we're looking at helping our clients, customers navigate the market, regardless of what gets thrown at them, whether it be news, disaster, you name it. Gary,
By the
moving
way,
on to
Rob, you know how calm DKI subscribers are right now?
yeah, I mean,
I
it's
I I did not get a single email, phone call, nothing today. The markets were down huge. The fight between Chairman Powell and President Trump has everybody upset. I literally did not get a single email or phone call from an upset subscriber today because we're hedged. Right? This like days like this do not cause us any problems.
yeah, and I
I
think
don't go
it's
to bed at
even
night. I don't go to bed at
yeah.
night worrying about whether the market will be up the next day.
Yeah, now obviously everything's relative too, but even on the days or the individuals that might not even be looking at things on a day by day basis too, we know that, hey, the approach is long term as well, right? It's, hey, what can we
Exactly.
plan for? How can we stay consistent? How can we obviously, yes, make the necessary moves and adjustment? But I think more importantly, just have your portfolio even in a position to be able to do that a lot of times is critical, and having an understanding of the information that's in your portfolio is more critical than ever. So again, any questions that you may have, go to the website, deepknowledgeinvesting.com. Use the Ask Gary feature, fire in a question. I would love to answer anything that you might have and get that on the show potentially if it's a good one. Gary, let's keep going. Thing number 4, we're talking consumer credit. The use of credit has actually fallen. Are we seeing this as the banks stop lending, or maybe just consumer wisening up a bit? Thing number 4, Gary, consumers tap the brakes, credit falls.
So, Rob, in February, consumer use of credit fell by $0.8 billion. And, that may not seem like a big deal given the fact that consumer credit use is in the neighborhood of $5 trillion. So, $0.8 billion on $5 trillion, it's de minimis, but analysts were expecting a $15.2 billion increase. And instead of getting this healthy increase, they got a decrease. So, in my opinion, this credit contraction is indicating continued signs of caution as more households are beginning to tighten their belts. One of the things that we're seeing are severely deteriorating consumer sentiment levels. Consumers are worried, they're upset, and understandably so. One of the things we've talked about constantly on the show is the fact that the productive private market economy has been in recession for more than a year. More than 100% of GDP growth is coming from government waste and congressional overspending. The people who are actually starting businesses, running businesses, making money, making goods and services, providing goods and services, that part of the economy has been slowing. And so it's understandable that consumers are worried. Certainly all of the press on, the fact that the Trump tariffs are there, or their speculation that the Trump tariffs are going to destroy the economy, that's not helping either. But consumer resilience has begun to slow. And in recent years, spending has been greater than inflation. We have a country that is just trained to spend, right? You're happy, you go spend. You're upset, spend. One of the terms I've hated, I despise this term, Rob, retail therapy. I
Retail
hate that.
therapy. Wow.
Yeah, I hate
That's
that
a new one.
expression.
I don't think I think my wife uses that one.
Yeah, it's the idea that if you're upset or depressed or your life isn't going well, go buy things. You'll feel better. I assure you, there is nothing that buying things will, like, if your life needs fixing, buying things won't fix it. Right? You have to address the problem, and spending money does not address the problem. It's not real therapy. I've always hated the expression. But the truth is here, if income growth doesn't continue, consumers have to cut back. And the one thing that's going to interrupt that is we are going to see an increase in retail sales because there's a lot of pre-tariff buying. People understand that there are going to be tariffs like on automobiles, and so people right now are walking into automotive dealerships and quickly trying to buy cars before the price goes up to reflect the tariff rate. So we're going to see a pop in that. But I do think it was really interesting that in February, we saw this decrease in consumer use of credit.
Gary, with that, and I brought it up in the intro, does this mean banks have stopped lending, or are we kind of seeing what we talked about in the past? Maybe, hey, consumers are actually just wisening up a bit, and doing the right thing, because there are some signs, I think, that are pointing towards that being the case versus the banks just contracting.
Yeah, Rob, I think you have it right. There were people last week who were claiming that the reason for the decreased use of credit was exactly what you said. It was the banks refusing to lend. I don't believe that. And the reason I don't is because, something we talked about, I think it was 2 weeks ago. Well, actually, sorry, it was like 1 week ago and 2 weeks ago, is that we're seeing American citizens, consumers starting to save more, and increases in investing by retail investors. So basically, what's happening is consumers are saying, I'm concerned about the economy. I don't feel as safe or secure as I did before. I want to save for a rainy day. And so what they're doing is they're saving and investing more. And that's not something that correlates with bank credit contraction, right? If the banks were reducing credit and people needed that credit to buy things, what we would see is declining bank balances, not increasing bank balances. People who need credit and can't get it, their bank balances don't increase. It doesn't make any sense to me. So, again, I don't think the banks deserve blame on this one. If you want to blame them for a bunch of other things, feel free. That's great. You're welcome to do that, but not this one. And, the message I want to send out is we, again, applaud any Americans who are buying less and saving and investing more. This is, one of the key things that you have control over. And, one of the things that we've talked about a lot are in particular with relation to a lot of young people. People are saying jobs are not available for them, and certainly not ones that will enable them to buy a house. And we've talked about how a lot of them are in a rough circumstance, that it's very difficult for them to buy a house and get married and start a family. And, I have sympathy for that. And I think that is hard. But the thing that you do have control over, you do have control over how much you spend, how much you save, how much you invest. And seeing Americans make that shift and take more control of their personal finances, spending less and saving and investing more, I think that's a great trend. I would love to see it continue.
Yeah, I mean, I think it's just even a global shift, Gary, right? And it really starts, I think, with the Bitcoin and the crypto movement, right? Of these individuals just actually finding a platform in which they felt, hey, I actually have a chance. I'm actually potentially not all the way. I'm sure we could talk about it and go down that rabbit hole, right? But okay, a market that at least, all right, wasn't fighting against inflation, wasn't fighting against interest rates, right? Wasn't fighting against the dollar going to zero, right? And seeing their purchasing power just completely get eliminated.
You know what, Rob? I'm going to add one thing to this too, on a personal note. Um, related to that idea that, well, if we spent more, if we had more, we'd be happier. I don't think that's true. And it's certainly not the case for me. I know a lot of people who are practicing minimalism who are really happy. And I know for myself, my normal life, I live in a big home in a really nice part of Connecticut and have a pool, and, it's really comfortable and nice here. And that's terrific. But, I travel a lot, and you'd be amazed. I find places for $30, $40 a night, and I don't necessarily have so much when I'm traveling, and I find that I don't need so much. I'm just as happy or happier. being in a studio or one bedroom. And I just don't need more things to be happy. That's not the thing that makes me happy. And one of the things, we've talked about on the show before is in 9 days, I've made plans to rent out my home for a year, and I'm going to travel, and I will be out in places. Every one of them will be much smaller and less nice than the home I live in. And I expect to have a fantastic time and learn a lot and have amazing experiences and develop inner strength and resilience. And I think these are the things that lead you to happiness. And I know that sounds weird for somebody. Like, I've spent my entire career figuring out how to make money, and I'm very motivated by making money. But, for me, that's how we keep score in this business. Like, the wins are fun because we won. I don't need to spend more or buy more. I just like winning.
Yeah. Yeah, no, I think it's a great point. And something that I'm seeing actually in the AI space, right, is there's this yearning of people that are buying from a marketing and advertising perspective from things that are actually real, right? Versus the AI component. And I'm going to loop this thought around here in a second. Is I think you're just also seeing it with human nature in general over the last 4 or 5 years, right? Everyone's been stuck at home. They've been working remotely. And so I think you're kind of seeing this renaissance of, hey, there's more to life than being tied to a screen and being manipulated in this market. And so you're seeing this kind of renaissance of, okay, I don't need the American big overbought house, overbought truck, this and that. I'd rather spend that time traveling or going and visiting someone or whatever it may be that's built more around community and authenticity. So that's my kind of roundabout way of getting to it. But like we're seeing it actually live in action with huge data sets of people we're advertising in front of that are saying, we reject this AI stuff. Actually, we want to buy from brands that are real, from brands that have community, that mean something, that aren't just all about the bottom line, which obviously, you get that big Google, Meta, ChatGPT, AI, Nvidia, Wizard of Oz, man behind the curtain trying to steal all of our money type of effect, right? So yeah, it's going to be interesting dynamics, going off on a little tangent there, but
No, that's right.
it should be
Rob,
interesting.
a lot of our young people take a huge amount of criticism. They get called a lot of names by older generations, but I think one area where they've made some really good decisions is, as a group, they've placed much less emphasis on buying things and a much greater emphasis on having experiences. They're buying less and traveling more. They have fewer possessions, but are going out in the world and doing things in real life. And
Yeah.
I think that's terrific. I completely support that. The other thing that I would note is that Americans are happily spoiled from having it really good. And there are so many times I talk to people who they complain about life here and we don't have enough and we have poor people here. And, when you travel the way I do and you see the rest of the world and you travel to these third world countries, what you realize is, in many cases, not all of them, but in many cases, being poor in the US means living at a much higher standard of living than the average person in some of these third world countries. And when I go to these places and I talk to them, a lot of these people are happy. They
Mm-hmm.
don't the thing that people respond to is change. I was in Vietnam in 1999, 2003, and again earlier this year. And, people there are thrilled right now because their standard of living has gotten so much better. And the standard of living in Vietnam is generally not better than it is here in the United States. It is for some people, but for most of them, it's not. But the change has made them really happy. And so, we tend to get very fixated on, absolute numbers, but it's really the change that makes people happy. And then, the thing that I would add is the thing that makes you really happy is what's inside of you, right? That whether you have a lot of possessions or few possessions, as long as, you have enough to live and, keep yourself from freezing to death, the rest really comes down to your personal mindset and individual resilience. And again, I know that sounds weird from a guy who spends all day thinking of ways to make money, but it's not. One is a profession, the other's a practice.
Yeah, no, I find myself too definitely driven by money and entrepreneurial, but I find myself putting more emphasis and importance on the opposite side, right? Balance is everything. So, all right, let's get rid of the warm and fuzzy feelings, and we're going to move into the heavyweight knockout, drag out fight that we've all been waiting for. Our fifth thing in the double Nvidia issue, which we're actually going to hit you with the bonus thing today. So stay tuned if you're waiting for the educational thing about stock splits coming here at the end. But President Trump, Chairman Powell, butted heads in public. Gary, you've got an interesting take here. Won't give it away. Thing number 5, President Trump wants Chairman Powell out now. You're saying why everyone is wrong. What does that mean?
Yeah, everyone involved here is wrong. So we talked earlier in this episode about Chairman Powell speaking in public on Wednesday and criticizing the Trump tariffs and, being very negative on the economy and making it clear the Federal Reserve wasn't going to bail out the stock market. Well, it only took President Trump one day to criticize Chairman Powell in public for being too late and wrong, and wrote that, quote, Powell's termination cannot come fast enough. He also made allegations that Chairman Powell has been making policy decisions based on politics, something the Fed is not supposed to do. Well, guess what, Rob? President Trump is right. Powell's done a horrible job. He left interest rates far too low and for far too long after the great financial crisis. I get why he dropped rates. Sorry, not just it was Bernanke who dropped rates, but when Powell took over, the Federal Reserve kept rates far too low. They should have raised rates much sooner. And then, by the way, if you hate income inequality, it's the Fed's loose money policies that were huge contributors to that. Powell was also too late in raising rates when inflation picked up in 2021. In November of 21, DKI put out a white paper explaining that inflation was a gigantic problem. It was not transitory. And, we told people at the time in 2021, buy gold, buy Bitcoin, buy energy. Those all worked incredibly well. In the meantime, Powell was laconically calling inflation transitory and waited months and months before starting to raise the Fed funds rate. When he did it too slowly. And so, I spent all of last summer saying Powell should not cut rates, and that if he did, he was going to end up regretting it. And here's what happened. Last September, the Federal Reserve started to cut rates, and they cut in September, October, November. And, I pointed out ahead of time and at that time that it gave the Federal Reserve, which is supposed to be a nonpartisan institution, the appearance of playing politics. What they were trying to do was support the Democrats in office. Everybody at the Federal Reserve despises President Trump. And so they hoped that by lowering the Fed funds rate, they would spur the economy and maybe give the Democrats a lift going into the November election. Well, not only didn't that happen, but when they cut rates, the bond market started to price in higher expected future inflation and raised the yield on the 10-year. So Powell lowered the overnight rate by 100 basis points. That's 1%. And the bond market raised the yield on the 10-year by 100 basis points, uninverting the yield curve. That wasn't the way they wanted to uninvert it, right? They wanted to bring the low end down and have the high end come down more. They got the opposite. Powell was wrong on that. They gave the appearance of looking like a political actor, and President Trump was 100% right in his comments criticizing Chairman Powell.
Gary, so lots to unpack there. I have lots of questions. Where do you side on this issue? Are you with President Trump? Should he replace Chairman Powell early? I know Trump, there's been some rumblings about wanting and putting some pressure for lower cuts, but isn't that kind of two-faced, right? Considering he's saying Powell is doing the same thing during the November elections. Break that down for me if you don't mind.
All right. So for the Democrats in the audience, if you guys have not tuned out, I'm glad you're here because this section is for you. While President Trump is right that the Fed has made massive policy errors and does appear to be a political actor trying to help the Democrats, the president now wants the Fed to cut rates, and that's a bad idea. See, Democrats, I told you we were going to be here for you. Powell was wrong to cut in September, and Trump is wrong to insist on rate cuts now. While the CPI was down last month, inflation is not under control. Concerns about that potential tariffs will raise the price index, they're legitimate. Even if I think they don't necessarily lead to long-term inflation, you could have a temporary spike, and it is something that we should be looking for. But Rob, my biggest concern on this is that unless Congress reduces spending, which is something they're not going to do, there's not much the Fed can do to help the White House. And, we were just talking about this before. When the Fed cut rates in September, the yield on the 10-year Treasury rose because the bond market priced in higher future inflation. So imagine that. Remember, prior Treasury Secretary Yellen left current Treasury Secretary Bessent a gigantic problem. Bessent has to refinance $7 trillion over the next 12 months. That is a huge number and desperately needs lower yields on treasuries to do that. So if President Trump gets his way and gets to fire Powell, put his own pick in place, his pick then reduces rates, guess what? We're going to end up with higher long-term rates. That is exactly what Secretary Bessent, President Trump's cabinet member, that's what Bessent is desperately trying to avoid. Basically, if Trump gets his way, he ends up pursuing a course of action that makes his policy goals less likely. Jerome Powell should ignore the president. And my verdict on this, in this matter, everybody involved is wrong.
All right. Gary plays Switzerland. We'll be right in the middle, but I agree with you, Gary. I love it. Hopefully, again, the Democrats held on for the last half of that segment. But if they didn't, please, I hope we should have told them this at the beginning, right?
Yeah.
Please leave a comment, ask us a question, thumbs up, thumbs down, share. Tell us we're not very, very smart, but please just make sure that you tell us why, because is one of Gary's favorite words out there.
There you go.
All right. We haven't forgot about the educational thing. One thing real quick, head to deepknowledgeinvesting.com, grab a free subscription, sign up with your email. That'll get you added to our email list. You'll get notified of content, especially the 5 things that gets delivered. You'll also see other content. It may be paywalled though, depending on whether or not that content is for premium subscribers or not. Premium subscriptions, $100 a month. That'll get you access to everything you could possibly imagine. Even Gary, maybe a few hours after close of the bell, maybe. Maybe it depends on how nice you are with those emails that you send in to Gary. So, all right, Gary, educational topic, thing number 6. We're talking understanding stock splits. Let's break it down, Gary. I'm going to start. What are they? I'll ask you when they occur. What's a reverse split? But let's just first start. What is a stock split, Gary?
So a stock split, it's a corporate action where the number of outstanding shares is changed. It does not affect the total market value of the company. So in a regular traditional stock split, the most common would be a 2-for-1 stock split. After the split, you will own twice as many shares as you did the day before. And it is typically done to make the stock more affordable for people who might not be in a position to buy a whole share of stock for their portfolio. So, in recent years, we've seen companies like Amazon, Apple, Nvidia, companies that, have multi-trillion-dollar market caps. When their stock prices go up to a certain level, $1,000, $2,000, $3,000, people will often be in a position where, hey, wait a minute, I can't afford one share of stock. They might have, a few $100s to allocate to a position in that company, but just to buy one share may be too expensive for them. So by splitting their stock, they increase the number of shares outstanding. That will decrease the price per share, and they make the stock more accessible to people who, can then afford to buy a single share or a couple few shares, depending. Now, a stock split does not need to be 2-for-1. I've seen them 5-for-1, 10-for-1. It doesn't really matter. It's just 2-for-1 is common, but we've seen pretty much every other permutation.
Gary, what are some things that investors? It sounds like it makes stocks more accessible to a wider audience, right? What are some things that they might need to be aware of, though, or at least some things that might be misleading?
Well, so one thing is people will often say, oh, well, great, I have more shares, I have more value. No, you don't. I have more shares, I have a different percentage of the company. No, you don't. You own the same percentage of the same company that is worth the same amount. It's just being expressed differently. The best analogy that I can give you is it's like having a pizza. You have a pizza. If you don't cut it, you have one pizza. If you cut it, once, you have two halves of a pizza. Cut it 4 times, you have 4/4 of a pizza. You still have one pizza. No matter how many times you cut it, no matter how many slices you have, it all adds up to one pizza. That's really what happens in a stock split. It doesn't really have any meaningful impact other than making the stock more accessible to a large number of people.
Gary, let's talk about reverse split, right? So you hear reverse split quite a lot out in the market. What does that mean for beginner intermediate investors that are curious?
So in a reverse split, it's the exact opposite of a regular split where the number of shares is reduced. And so it could be 2-for-1, it could be 10-for-1. But let's say you have a reverse split, it's a 10-for-1 reverse split. You own 10 shares, and following the split, you would own 1 share. Now, you still own the same percentage of the company. The value that you own is still the same. But instead of, 10 shares trading at a very small number, you would own 1 share trading at a larger number.
Gary, we're going to close with some misconceptions, right? So stock splits have a lot of misconceptions. I think we have 3 main ones. So Gary, we're going to talk about the 3 misconceptions of stock splits. Tell us what investors. There's that tongue tie we were talking about, right?
Yeah.
Stock splits. What was the third word that someone threw
remember.
into the script? I can't remember. But Gary, tell us about these misconceptions that we need to be aware of.
All right. So the first one is a lot of people think a higher or lower share price means the stock is worth more or less. That's not true. If that were true, companies could increase the value of their business by just doing reverse splits and reducing their shares outstanding. Real value comes from the tough work of increasing sales and margins. That's the only way your position will be worth more. A second misconception is a lot of people will say a stock split is bullish, a reverse split is bearish. That's generally not true. The splitting itself doesn't really affect the company, only how investors feel afterwards. Now, the reason I say generally is it is true that companies with rising stock prices tend to do a stock split, and that signals to the market confidence that past growth will continue. They're saying, hey, look, our price has gone up so much. The future looks really good. We're expecting the stock price to continue going up. So, we're going to split the stock. And that does create a certain amount of excitement. It's also worth pointing out that on a reverse split, those are often done because, a stock may be trading below $1 and certain people don't trade penny stocks. They won't own stocks that are trading at less than $1. Some of the market exchanges have limitations. You need to have a stock price of above a certain number. And so, you'll often see reverse stock splits done by companies that haven't done well. Their stock price has gone down by a lot and they're doing the reverse split to avoid a delisting. But it doesn't really change the value of the company. It's merely the external events, or the company events that's causing the stock split, either the regular stock split or the reverse stock split, rather than the stock split creating the value itself.
Great stuff, Gary. And that concludes this week's version of the 5 Things, the April 18th edition of the 5 Things to Know in Investing this week. We're calling it the Double Nvidia issue. Again, be sure to head over to deepknowledgeinvesting.com, sign up for a free subscription on the website to make sure you don't miss any future versions of the 5 Things. And be sure to subscribe, turn on notifications. That'll allow you to be notified when new videos hit. We break these down into the individual segments, YouTube shorts, the whole 9 yards. Thanks so much for watching. Gary, I'm going to turn it over to you for the final words.
So another great week by DKI intern Cash and Crow. We did a terrific job putting together this version of the 5 Things. Great job, Cash. And Rob, always appreciate doing this with you and the great team at Flying V. Nazim does an amazing job getting us ready for these. So along with, so many other people at Flying V. And then, for our audience, we know your time is valuable. Our views are growing. Our subscribers are growing. Thank you so much for your time. We appreciate you being here with us, and we will look forward to seeing you next week for another version of the 5 Things. Thanks a lot.
Thanks, everyone.